What's going on, everybody, and happy Friday. Welcome to another edition of Friday Wrap Up with yours truly, Kevin Weedmark, where I very quickly want to bring to you every Friday what happened this past week. So whether we're doing some open houses this weekend, we're taking clients out, we get a call, we want to actually make those touches, right? Or we're standing in a grocery line, or we're doing some Christmas shopping, we get into a conversation, we want to be able to talk about what happened this past week. And the biggest thing was rates were up every day this week, and some days were a little bit less than others, but overall the market seemed to actually increase about a quarter. So the quarter that we got last week, we lost it this week. And the biggest culprit, there was a few things, but the biggest one was inflation. We had both CPI and PPI come out. Consumer price index was out. It came in at forecast, but once you looked at the numbers, we saw that food actually went up from an inflation month over month and year over year. Shelter came down, which was a great thing, but the food on the high side was a little concerning, in my opinion, to traders. And then we had PPI come in, the producer price index, on Thursday, and that actually was over forecast. So that was a concern as well. The other things that we had is we have a 95% chance that the Fed is going to reduce the Fed funds rate come Wednesday of next week on the 18th. And I actually think that traders are not so hot on that, right? I think that they're looking at the long-term effect of lowering that Fed funds rate. It means more purchasing power, or I guess borrowing power for a lot of businesses, which means that there's going to be a lot more money flowing around in the economy, which seems to be running a little hot right now. We're running about 2.7% on inflation on the CPI, and it just remains sticky. So I think that's a major concern. And then we also have an incoming administration, which has talked heavily about tariffs. That rhetoric is starting to pick up a little bit this week. So that weighed on traders all week, and we saw a lot of people just flee in anticipation, as well as I just said, of what that effect is going to have with the Fed next week. Again, traders are always forward thinking, but I just think there's still just a lot of concern over what that means long term. And I honestly think that the markets are really trying to figure it out. The other thing that we saw is initial jobless claims came in a little bit higher than forecast. So that is another reason why the Fed wants to keep their foot on the gas pedal with reducing that Fed funds rate. They do not want to see the labor market struggle and us to fall into some type of recession. So they want to actually keep reducing the borrowing power of businesses and corporations and banks from the federal government. The other thing that we saw was the ECB, the European banks. They actually decreased their interest rate this week, which kind of set the traders on the U.S. side a little bit like, well, what's going on over there? Should we have concern? They really did it in anticipation of the tariffs that are coming. So once again, it raised the concern of those tariffs, which is the concern of long-term inflation, right? And then this week, to be stressed, this week I want to stress, I should say, a better way to say it is, the biggest messages I have and that we should be telling our clients as we head into this weekend, or we're talking to them, is, look, the best thing we can do is be prepared. Talk about it all the time. Make sure that your clients, if they think that they're going to be purchasing in Q1 or Q2 of next year, get your ducks in a row. Start talking to that mortgage professional now. Know your numbers now. Get your pre-qualification now. Do you need to run a hard credit pull? No, you don't. But you need to know what's on your credit. Maybe you need to work on your credit. Maybe you need to get that credit score up to get you in the best position. But be prepared, so that what we see is these peaks and valleys with interest rates, right? They're going anywhere from a quarter point in a week swings to a half a point we've seen over the course of 4 months. We've seen a full point in the 4 months that just recently. That is a big change in purchasing power. So what I'm saying is, being prepared, getting these people, making sure that when they're ready to go make an offer because their purchasing power increased or their payment went down, and they're ready to write that offer, and they want to be the ability to be aggressive in those valleys. So that would be my big message. And as always, lock those dips. We are still in for a bumpy ride with the incoming administration for Q1 and Q2. So you want to make sure that you lock those dips. All right, everybody, have a great weekend. I'm around. You need a flyer, as always. You need a pre-approval. You have a question for anybody, please do not hesitate to give me a call, email, text, whatever it is. I'm always available. Within at least an hour, I'll be responsive, and I'll give you a timeline when we can talk and discuss any issue, or I'll be Johnny on the spot. All right, everybody, have a great weekend. Enjoy yourselves, and I'll be talking to you on Monday with the weekly market update. Cheers.